JB here, JB here. Hope everyone's doing outstanding. Monday, September 18th, 9/19. Sorry about the delay. Talk really quick about the market. Some names I'm looking at go from there. Just a quick side note, a little raspy today. I'm feeling under the weather, so I do apologize for that. Take a look at S&P futures in the green. Markets looking to continue last week's green week, right? It was a holiday shortened week, despite the weaker than expected job numbers from August. Markets bounced off the bottom at about 11 o'clock. Still closing red with green on a week, and a lot of headlines over weekend, right? I put on the watch list. It's funny, the spin, right? And the spin is, the first negative month in job creation since 2020, right? Because the downward revision, I think, was July numbers, back into the negative. And then you would think, oh my gosh, that's hard. Market's going to sell off. Then on Sunday, there was reports that the Japan prime minister is resigning, right? That's the hawkish fellow, the one that they were worrying that there was going to be some kind of yen carry trade 2.0 fiasco, right? The last time we had that was the summer of last year. We had the big pullback. People worried about uh, people selling, that because of the decades of lost growth in Japan and the low yields, it required folks to go outside of Japan to get returns, right? So when they take their money outside Japan and they go and invest in the US, and then all of a sudden yields start going up in Japan and the currency strengthens, boom, you have a situation where you gotta reverse that. You gotta unwind it. And that was gonna be the next catalyst. Suppose that was happening in the fall, in the summer. Then it was gonna happen back when the Liberation Day situation came on fiasco, right? The US Treasuries were losing its reserve stat. Well, the US dollar was losing its reserve status. Treasuries, people were not having appetite for US debt. And now it's fast forward and it's like, okay, well, let's move on to the next one. Next one today, the headline, it's the UK, right? And there was talks about last week, UK 30 yields, five and change, the highest it's been in whatever, long time. So now there's talks about the UK being kind of like the tip of the iceberg and the canary in the proverbial coal mine. And we'll see how that all plays out. I hate to like dismiss things, right? Because, it's always good to know what's going on because at some point, maybe one of these events will cause a pullback, right? There's always been countries over the years, China in 2015 in the summer. There's always been some of those situations that were catalysts, whether it was just for people profit taking or for other scenarios. But for now, I put the range this morning, 638, 656. We do have some data this week, PPI Wednesday, CPI Thursday, 3% estimates for both readings Wednesday and Thursday. We still get the weekly jobless claims on Thursday. Still earnings. We have Adobe, Oracle, which has been on a monster tear. I think there's only like 50 companies reporting. GameStop. So certainly interesting to see how those play out. But it's hard to think, besides the historical time frame we're in, which is September, which is not the best performing month, hard to think what might derail this now. So for now, that's kind of the range. Also, I mean, yields. You take a look at the probability of a Fed rate cut. Now people are talking about another jumbo cut, right? The probability of a rate cut meeting next Wednesday, 100% for a 1/4%. Possibility of a 0.5%, but that's up to like 10% probability. I hope it's not a jumbo cut. Keep it a 1/4%. Do it for the next three meetings. I think that'll do well for the markets. Take a look at the 10-year and the 30-year. And a lot of times they kind of move in lockstep, but you can see some divergence here. People like to say, oh, when when they're inverted, that precedes recession. Now that's not inverted, so now they'll use some other kind of meaning, like, oh, 30 years still high relative to the 10-year, or funny stuff. All right, so that's kind of overall market. So now just individual names. Some names I like with yields going down. Pool obviously is one of them. You have the Buffett backdrop. You also have, I've talked about this for a couple of weeks, and especially when I talk about Pool, people looking to do things when rates go down, they become more apt to do it. And that's why you saw names like RH, expensive high-end furniture. People go in and they get lower rates for their furniture. You have to think the market's going to start pricing that in before it happens, right? So that's why I really like Pool here, up 5% Friday, up 7% for the week. My calls are back to life. If it gets over 335 at the open, it's not the most liquid name. I might try to scale in some higher strikes or later dated strikes for a move past 345. And that's Pool. Nike. I was talking about Nike yesterday, Friday morning, right? More of like a reverse play on Lulu, because if you look at a name that's been resilient amongst all the possible scenarios that might dampen their brand has been resilient and continues to be. And I mean, if you know about the sneaker side of it, like that, that's never. Oh, I would say never, but they're like collector items. There's not no other brand that really does that, and just because of that, I think that keeps their brand awareness strong, and the fact that it's down here, new leadership in place. I mean, it's been in place for a while, but their last earnings, nice gap and go. And I still think there's concerns around tariffs and things, especially when a lot of their products are manufactured somewhere else. So I think it's an opportunity. I don't know who put it on, who upgraded this morning, but I might get some strikes. They report earnings September 30th. I might look for some spec calls for this week, possibly into next week, for a move up to $80. I might also look to get out to October, but you have to go all the way up to the 85s to find a decent risk reward strike. But really like the Nike setup here, and take a look at the 50-day moving average 74.73. It gets over that today. I think that'll be confirmation. So that's Nike. IIPR right up to resistance on Friday, and then just chopped around. Their ex divvy date is also on September 30th. So keep that in mind. I'm going to probably look to lock some more of the Octobers or all of them out at some point today, and then use that to either roll higher strikes or further out. Still, only ticking time bomb on the cannabis space. Then on the flip side, right? They talk about luck being prep when opportunity meets preparation. And so many times over the years, there's been trades of lucky both sides. TTD, I got added to the S&P 500 a day after I got my calls. Boom, a couple thousand%. Got the hood spec puts more as a hedge, just because I was concerned over the weekend people might jump the hype train and do some selling. And sure enough, after the close Friday, finally added to the S&P. If there is some weakness this week, and I'm not going to rule it out, I'm just a little more optimistic this week than cautious. I'll probably just stick to SQQQ calls as like a small hedge, just because instead of trying to catch some of these individual names, I mean, unfortunately, the two names I had for hedges last week, I could have got the Visa puts, and those would have paid out. I think Visa were like 348 or so when I got the hood puts, and it dropped another $8. So that would have been the trade. But for now, I'll just kind of like, I wouldn't say sit on my hands, but if I do look for some areas to get some hedges, maybe we break 643 here today, I'll get some SQQ calls. Now, obviously, still have my eyes on Serve Robotics, still my eyes on Joby, but going to be patient there. And you got to think, with the yields going down, the small caps and biotech names may be back to outperformance. So, all right, let's have a great day, folks. I'll be back on audio later. Rock and roll.